Hey, welcome back to the channel. I'm Troy Evans, and today we're going to be talking about raising capital, and we're going to be specifically talking about the pros of raising capital via debt. Whenever you raise capital, you have the option of choosing between raising it via debt or raising it via equity. There are pros and cons to both, and we're going to talk about the pros today, taking a look at the video on the cons of raising capital via debt. Make sure you do that after this video. Also, before we dive in, make sure that you hit the like and subscribe buttons so that we can continue to bring you some great content such as this. And lastly, remember that this video is for educational purposes only, and before you make any type of investment or business decisions, you should always consult with a professional such as an attorney, a tax accountant, or a financial advisor. Now, I've raised over $100 million in capital, and there are situations that call for debt to be deployed, and there are situations that call for equity to be deployed. Now, the number one reason that I use debt to raise capital over equity is because I want to keep a greater percentage of the opportunity. So whenever you are raising equity, you are giving up a percentage of ownership, which also means you're giving up a percentage of the upside. So I always think about what is the potential of the business that I am starting or creating. And let's say that that business in the next 5 to 10 years is going to be making about $10 million a year revenue, and we'll have a profit of, let's say, $2 million, so 20%. If the company is going to be making $2 million in the next 5 years and it's going to make that on a regular basis, then the question I have to ask myself is, how much money is required to be invested in this opportunity in order to reach that potential? Now, let's say, to be facetious, that you only needed to invest $1,000 in order to build your company up to that in the next 5 years, you're going to have a company making a profit of $2 million a year. You only need to invest $1,000. Well, if you don't have the $1,000, it would be silly to give equity to someone for the $1,000. So for instance, let's say someone says, hey, Troy, you need $1,000 to start this business. It looks like it's going to be extremely profitable. I'll give you the $1,000 for 50% of the company. So what you're saying is that in the future, let's say you don't make any profit until year 5, but in year 5, you make $2 million in profit. You're going to give someone 50% of that $2 million, so $1 million, because they gave you $1,000. That would be silly, right? Now that's facetious because there's probably not that many opportunities in which you're going to be able to create that type of revenue and profit off of $1,000 investment. But the point is the same. You have to look at how much money will it take you to reach that potential of revenue and profit. And then you have to decide, do you have access to that money, and is it better to borrow it, or is it better to provide an ownership percentage to an outside investor? For $1,000, I'm always going to opt for debt because I'm going to keep 100% of the company and just pay a fixed interest percentage back to the investor or lender. But let's say I needed $1 million in order to reach that goal. Well, I might not want to pay interest for the next 4 years on $1 million. I might want to give up an ownership percentage in order to get there. And especially if the opportunity is not guaranteed, giving up an equity percentage means that the investor is also sharing in the downside and not just the upside of the opportunity. So pro for using debt to raise capital is that you get to keep a greater percentage of the company, and you have to determine what amount of money you need is worth switching from debt to equity. The second pro to using debt to raise capital is that the paperwork is a lot simpler. Now, this may seem like a trivial reason to use debt, but it is a substantial one. I kid you not. I have raised capital via debt and equity. And when I raise capital via equity, I'm normally dealing with a private placement memorandum and a subscription agreement, which means that I have lawyers involved. So the more complicated the paperwork, the more expensive it is. And I've paid on average about $40,000 to $50,000 for that type of paperwork. So maybe you don't want to invest that type of money into raising capital. And I wouldn't suggest spending $40,000 or $50,000 if all you're trying to raise is $100,000. Like, why would you want to spend that amount of money, 50% of the total expenses on, or 50% of the total amount you're trying to raise on just the legal paperwork? With a debt agreement, you're normally just going to be dealing with some type of a simple note, some type of promissory note, and you may even have a collateral agreement such as a mortgage if you're dealing with real estate, or some type of other collateral agreement. But those are going to be two very standard and simple documents that you can find on the internet, and they're not as complicated as a private placement memorandum or a subscription agreement or some type of other legal document you will need in place in order to raise equity. So the second pro of raising capital via debt is that the paperwork is a lot simpler and therefore less expensive. The third pro of raising capital via debt is a predictable rate of return for your investor/lender. And this can be a pro for you, and it can be a pro for your lender/investor, because it allows you to plan adequately for your interest payments. So you're not going to have unpredictable amounts of money going out of the door, and your investor or lender is also not going to wonder how much money they're going to get. It is built into the debt structure, and you're going to make regular payments, be it monthly, quarterly, or annually. You know what it is, it's predictable, and that may be something that attracts investors to you. So it helps you with planning and budgeting, and it may also attract a certain type of investor that doesn't want to deal with the ups and downs of making an equity investment. So to make it simple, if you borrowed $1 million and you had a 10% interest payment, you're going to be paying $100,000 a year, and that's either going to be annually, quarterly, or monthly, and you can plan for and budget for it accordingly. The fourth pro of raising capital via debt goes along with the third pro, and that is a greater rate of return to the owner. So if you are making debt payments with a predictable rate of interest, it is normally going to be substantially lower than any amount of equity that you've given up, and therefore percentage of profit that you have to give to your investors. Now, this is only if you have a profitable business. If your business is losing money and you have debt payments that you have to make, that can become quite burdensome and can really cause you to stress out and lose your hair. But if you are confident that your business is going to be making money, or if you already have a business that's making money and you need to raise additional capital, then with debt, you're going to be paying a lower rate of return to your investor/lender than if they were to make an equity investment and you were going to have to give up a percentage of your profits. So if you want to keep a greater percentage of the money that you're making, then debt is a great solution for you. The fifth pro of using debt to raise capital is the collateralized nature of debt, meaning that you can always put up some collateral in order to make the investment or loan amount that you are asking for safer. Anytime you can de-risk an opportunity to an investor or a lender, it is better, and it is going to attract more people to your opportunity. This also means that you are going to be able to, in the case of like real estate, use the asset you are purchasing to collateralize the loan, and therefore you don't necessarily need to use any of your personal assets. So it's one of the things that can make debt an attractive form of capital, that you can de-risk it and make it safer for investors and thus attract more investors to the opportunity, as opposed to equity, where in order for an investor to get their money back out of the business, if things go wrong, they're going to have to sell pieces of the business, which is not always attractive and can also be very complicated to execute. So that is the fifth pro of using debt to raise capital, the collateralized nature of debt. So there you have it, 5 great reasons to use debt when raising capital. The first is that you're going to be able to maintain a greater percentage of ownership in your opportunity and thus the decision-making ability. The second reason is the simplification of the paperwork and thus keeping your costs low. The third reason is providing a predictable rate of return to your lenders/investors and thus making it more attractive and also easier to plan and budget around. The fourth reason is the fact that you're going to be able to actually capture a greater return for yourself. And the fifth reason is the collateralized nature of debt. Hopefully this was helpful to you. If it was, do me a favor, hit the like button, hit the subscribe button. Also, I'm interested in knowing if you are going to use debt or equity on your next business opportunity. Leave me a comment below and you can always ask questions and I'll get back to you as soon as possible. Thanks for tuning in and I'll see you next time.